In the second quarter, since the coronavirus emergence and the related shelter-in-place orders, we experienced a historic hit to real GDP. Since the second quarter, the economy has made significant progress, and we expect strong real GDP growth in the second half of the year. Yet it still faces considerable weakness and potential headwinds heading into the end of the year. We have concerns that a resurgence of COVID-19 in the fall will cause another increase in unemployment as aggregate demand, driven by decreases in activity in the service, entertainment, and hospitality sectors, will fall again. Inflation still runs below the Federal Reserve medium-term target of 2%, and the Federal Reserve has taken steps to put upward pressure on inflation by changing their inflation targeting strategy. The Federal Reserve has taken the necessary drastic steps to combat the high unemployment and collapse in aggregate demand during the COVID-19 crisis, and monetary policy over the short to medium term will be designed to continue to provide relief and support economic growth with a particular eye towards labor market stability and growth. The Federal Reserve commits to remain ready to provide relief. Here we have the FOMC's dot plot, or the projections of the federal funds target over the near and long term. The FOMC expects to stay at or close to a zero interest rate for as long as COVID-19 is an issue. Long term, the FOMC expects the interest rate to increase between 2% and 3%. We expect that the neutral interest rate will remain lower than the previous normal over the longer terms, which will make the monetary policy decrease in aggregate demand more difficult in the future.
We will begin by looking at output. Output is a great way to determine the economic well-being of the United States situation. With traditional GDP being measured quarterly, we can only see the fall in GDP after the second quarter, even though GDP has risen since the end of the second quarter. Durable goods, after falling, have reached its prior 2017 levels. Output gap shows that the United States' current output is not meeting the potential output. Manufacturing has also fallen in 2020. In the second quarter, we experienced a historic decline in GDP due to the COVID-19 spread and the policy response by states and the federal government. The information available at this time suggests that U.S. real GDP was rebounding at a rapid rate in the third quarter. GDP is projected to rise to the same percent growth as before the pandemic. While the rate of growth will recover, it will not meet the same trajectory as before the pandemic because GDP will not experience catch-up growth with a rate above the previous rate of growth. Because GDP is calculated on a quarterly basis, estimating the trough from the COVID-19 pandemic and shelter-in-place orders is difficult using traditional GDP data. Therefore, we take advantage of recently released data from Raj Shetty, John N. Friedman, Nathaniel Hendren, Michael Stepner, and the Opportunity Insights team published in Economic Impacts of COVID-19. Evidence from a new public database built from private sector data. They built a publicly available database that tracks economic activity at a granular level in real time using anonymized data from private companies. This data source reports daily statistics on consumer spending, business revenues, employment rates, and other key indicators disaggregated by zip code, industry, income group, and the business size. We can see that consumer spending fell by 33% from the beginning of the year in early April, before slowly recovering. Through the summer, it remains about 4% below the early 2020 level. The output gap shows the difference in potential and real GDP. The fall after the pandemic is more drastic than we have ever seen from the financial crisis in 2008. And with no third quarter data yet, there is no way of showing the output gap rise until that data is measured. However, we have preliminary evidence of improvements in output, and we can tentatively say that the outputs have been reduced in the third quarter from substantial increase in quarter two. The Purchasing Managers Index is a measure of the prevailing direction of economic trends in manufacturing and closely tracks output. A PMI rating below 50 shows negative sentiment among firms and expectations of a decrease in aggregate demand. The fall after the pandemic reached 40%, which is still above the level in the aftermath of the financial crisis. Turning to consumers, real disposable personal income increased in April of this year due to COVID-19 related policy responses and consumer decisions to forgo consumption due to safety concerns. As fears of COVID-19 waned and shelter-in-place orders ended, consumer spending increased and disposable income fell. The opposite trend can be seen with real personal consumption expenditures, which has nearly returned to its level from January 2020. Consumer confidence measures how confident people are in the economy. The fall that is seen after the pandemic has not yet reached levels of the financial crisis and have slowed at around 70%. Indicators of business fixed investment suggested that this sector was beginning to recover on balance. Durable goods orders show the confidence that consumers and firms have in the economy going forward. Because durable goods are expensive and typically require borrowing to finance, consumers and firms must be confident in the near term about their employment or revenue projections. After falling in the second quarter in 2020, it has rebounded to reach 2017 levels, showing some return towards trend, but this still is below the level before the pandemic.
The labor market shows what the current status of unemployment is in comparison to recent history as well. Current unemployment shows a rate of 7.9%, which shows a quick recovery in regards to the major drop due to COVID-19. However, this is still higher than the trend of recent years. The unemployment rate was affected by COVID-19 heavily, with many people being laid off or losing work. As businesses open back up and COVID-19 becomes under control, the unemployment rate will continue to decrease. Total non-farm payroll employment expanded strongly in July and August, although payrolls had recovered only about half of the jobs lost at the onset of the pandemic. Of particular concern is that low-income workers have seen the fewest gains in employment since the COVID-19 recession began. This will require further accommodative monetary policy. There is some concern that this underestimates the true level of unemployment because many have been unable to look for work with business closures and weak demand in certain risky industries, thus not counted in the labor force to calculate the unemployment rate. Initial jobless claims spiked in the first few weeks of April in response to COVID-19, but have steadily fallen through the summer. We have seen this trend slow into the fall and remain far above the pre-pandemic level. Current estimates of the natural rate of unemployment have not increased since the emergence of the pandemic, suggesting that the disruptions to the labor market, though severe in the short to medium term, will not become long-run structural changes. Job openings available for workers and new job hires both fell in the second quarter. In the third quarter, we have seen an increase in hires as firms rehired workers laid off temporarily during the early spring. Job openings remain subdued, but above much of the 2008 post-recovery. The quits rates typically shows how confident workers are in the labor market as they are willing and able to leave their job for another position they've accepted or want to search for. It fell to its lowest level since 2012 in the second quarter before rebounding in the third quarter to near the pre-pandemic levels. The labor force participation rate has fallen during the pandemic, but we are unsure whether the decrease will be permanent or are due to temporary business closures in response to the pandemic. We will be watching the array of labor market indicators of labor market conditions.
Price level has been consistently below the Fed's objectives, even with some recovery being in the recent months. Turning to inflation, overall consumer prices as measured by the Personal Consumption of Expenditures Index has risen 1.38% this year. Despite its recent rebound from the trough of less than 0.5%, it is still down from the rate last year of above 1.5% and considerably below the Federal Reserve medium-term 2% objective. This reflects both weak aggregate demand and a considerable drop in the consumer energy prices earlier this year. Core PCE, which includes the volatile food and energy prices at 1.5%, as a transitory influence is holding down inflation from COVID subside over the medium term and the labor market improves, we expect inflation to return towards the Fed's objective. However, this may take some time as the COVID-19 pandemic will influence human behavior for some intermediate time. We will continue to measure actual and expected progress towards our inflation goal while formulating future policy. Producer Price Index indicates the prices that producers pay for the inputs into their products. This can be a leading indicator of future inflation, as changes in the prices of inputs into goods will leak into the future prices of goods. Currently, it is running below zero, suggesting that there will be no pressure to increase the prices of consumer goods. Labor costs are the other indicator which can give us a view of future price changes. Typically, an increase in average hourly is a leading marker in looming inflation. However, the typical changes in hourly wages are due to a tightening labor market where firms are forced to bid higher wages to potential employees to get them to leave their current firm and join them. In this case, average wages are increasing because lower wage workers are losing their jobs at a higher rate, changing the composition of the labor market. Despite the increase in average hourly wages, we do not expect the price level to increase.
U.S. financial markets show some recovery since the major drop-off in March of 2019. It is evident that there is a continuing strength in asset prices, which shows that investors are confident in the long-run effects that will not be a problem area due to the global pandemic. The improvements in asset prices were caused by a combination of declines in the number of new COVID cases in the United States and stronger than anticipated corporate earning reports and domestic economic data releases. Turning now to the spread between the 2-year Treasury and the 10-year Treasury, we have seen the spread increase since the late 2019, suggesting a steepening yield curve and expectations of stronger growth or higher inflation. Looking at global economic activity, foreign economic activity plunged in the second quarter as a result of the COVID-19 pandemic, both fears by the consumers and government restrictions in order to prevent the spread of the disease. The economic turbulence shared by foreign countries also hit the pandemic, reduced demand for U.S. exports, putting further drag on the real GDP growth. There was a large but incomplete rebound in the third quarter for many large economies across the world. Specifically, we saw marked improvements in Canada, the Euro area, Brazil, and China. However, there remains considerable uncertainty due to increased COVID cases and the threat of resurge in many countries, which limits the chance of recovery and our confidence in economic conditions looking forward. The Fed balance sheet was beginning to decrease after the Fed's quantitative easing programs and the return to normal interest rates. The Fed used some liquidity facilities early in the COVID-19 pandemic, but that has ceased. The Fed has also begun buying assets again in order to provide accommodative monetary policy to support economic recovery. The independence of the Federal Reserve from political pressure has become an important concern in the past year. Remaining independent from elected officials is essential to maintain the integrity of the Fed and ensure the monetary policy is implemented for economic conditions, not for political reasons. Decision-making should continue to focus on achieving the Fed's dual mandate. When the central bank becomes involved and succumbs to political pressures, the central bank tends to unanchor inflation expectations and suffer from persistent high inflation.
The FOMC seeks to provide price stability and unemployment under its dual mandate as given by Congress while promoting financial stability. Given the economic conditions and the uncertainty surrounding the economic situation and pandemic, the Federal Reserve's monetary policy stance has become accommodative this year and will continue for the medium term. The goal is to promote recovery and growth in the labor market and return of inflation to its 2% average objective. Specifically, the FOMC should keep the target range for the federal funds rate at 0 to 0.25% and do so until the labor market conditions have reached levels consistent with the FOMC's assessments of maximum employment and inflation has risen to 2% and is on track to moderately exceed 2% for some time. With inflation running persistently below the longer run goal, the FOMC should allow inflation to reach above 2% for some time so that inflation averages 2% over time and longer term inflation expectations remain well anchored at 2%. We believe that FOMC should maintain monetary policy in an accommodative stance until these outcomes are achieved. We believe that FOMC should err on the side of accommodative policy given the headwinds facing the economy. In addition, we believe that the FOMC should use forward guidance to commit keeping the federal funds rate low for the foreseeable future in order to increase inflation expectations and put upward pressure on inflation, helping to return to the FOMC's 2% objective. We expect that the federal funds rate will remain at the zero lower bound for the medium term, lower than will prevail in the long run, due to the mentioned headwinds, which include weak aggregate demand, high unemployment, and interest rates below the Fed's target. The interest rate needed to keep the economy operating near its potential is low by historical standards, and the policy rate has already reached the zero lower bound. If, for some reason, these headwinds caused by the pandemic suddenly end due to vaccine or treatment becoming available, the FOMC will have room to increase rates consistent with our goal to maintain price stability. To prevent the economy from overheating, given the forward guidance, including the headwinds caused by COVID-19, necessary increases in target rate will not erode trust in the FOMC's communication strategy. The FOMC should be willing to use its full range of tools in order to support the economic recovery. This should include purchasing agency mortgage-backed securities and longer-term treasuries. While purchases of longer-term treasuries may not be necessary at this point, if the FOMC requires more tools to put downward pressure on the interest rates, they should consider using purchases of longer-term treasuries.